Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 12th edition of Market Outlook. So the market continues its relentless rise. According to a Gallup poll this week, investors are the most uninvested in this particular stock market rally since the last 15 years, and it's percentage-wise one of the most underplayed market rallies that we've ever seen. So, with that said, as the market is confirming and staying above new highs and people are underinvested, it certainly points to, over the longer term, continued upward trend remaining intact. But meanwhile, let's go exactly to what the market internals are showing, and also let's take a look at some of the key charts. I know last week we covered the S&P, but we're going to cover it a little bit more in detail today. As you can see, we had another banner week, closed up, and stepping back again and looking at the monthly charts, you can see a couple of things. Number one, I put in this parallel against the very, very significant long-term lows. Now that we've actually made new highs, we can make some inferences as to what the channel is that's forming over a many-year period. So with the new highs, you can see the channel basically, which goes back to the mid-90s or early 90s, and a parallel up to here, brings you up to about the 180 level or so, which is a nice additional at least 10% rally from here. So that's fairly significant. However, one thing to take note is that the relative strength index on the monthly charts is overbought. Now, they have a tendency to be able to stay overbought for long periods of time. So it is a little bit of a yellow flag, but again, things in motion, especially like this, making all-time new highs, have a tendency to continue in motion. And I also put in this deep rectangular box here, which sort of denotes where the upper ranges of the travel might be, and also should we start undergoing some sort of correction. But it's going to be important to refer and remember this particular video, because inevitably we will get a correction. People will say that the rally's over, the market's finished, and that's it. But the truth is, you have some really good support around the 150 level. So that's still a good, 10%, 8 or 10% move down, and the rally would still be intact. In fact, this blue line here is the rising 65-week moving average, and you can see an attack of that 150 level at some point. This would still be a market that is in a firm bull trend. But most likely you should find support against these recent highs that occurred in 2007 and similar highs that occurred in 2000 and 2001. That should be your main level of support, and as well as this channel line up here. So that is your broad perspective on the S&P 500. Let's take a look at some of the market internals. Okay, well, interesting. We definitely triggered an overbought condition in McClellan Oscillator, which is really for swing to position traders looking out over a week to a month or so. And as you can see, we got to the overbought region. It's about the most we've been overbought since the beginning of the year, and we hooked down under it even as we closed on new highs. So this is definitely telling you things are a bit frothy longer term, and or at least for swing to, people looking out for a month or so, maybe even a little bit more. However, let's also take a look at some of the shorter term indications of the market internals. This particular chart here, the advanced decline and the up-down volume, clearly at overbought readings. You can see that we've hooked down. We actually went beneath the key point here on up down volume and then popped above it. So again, running rich. We haven't generated quite the sell signal until we back off quite a bit more on advanced decline. So the market internals a little bit mixed shorter term. Definitely generated a signal on the short on the intermediate slash swing trade. So that is definitely cautionary up here, even though the longer term trend, the very longer term trend, remains intact. Let's take a look at bonds. On the weekly chart, you can see that we've closed under the key 65-week moving average with gusto. So clearly you can see, going back years, we've had these artificially low rates supported by the Fed and bankers all over the world, but it's certainly running out of gas and looking like it's topping out. So the recent action, especially this week's action, crossed back under that 65-week moving average, put us back into what I would call a pretty strong warning phase, as that 65-week has basically flattened out. Looking at the daily chart on bonds, right? These are a 20-year bond ETF. We basically had this declining 200-day. We got above it. Still, it was like a magnet. Couldn't really develop any momentum and really fell apart through it this week and closed well under the 50-day moving average and under the 200. So you are in a bona fide, on the daily chart, bearish phase, right? The 50 under the 200, the market trading under it. That is clearly a bearish phase, and you can see that it went through with some real momentum and also some pretty good volume. Now we're approaching oversold, but not quite there yet. So again, a little bit of caution here, because we move pretty quickly within just a couple of days from a weak accumulation phase to a bearish phase within 1 week. So that's a lot of movement. Okay, let's take a look at the VIX. VIX market sentiment. You can see market sentiment here. We're trading under the 50, under the 200-day. Interestingly enough, a little thing to note here is that the trend has been rising in the VIX. So even though the market's been making new highs, it hasn't been followed through by the sentiment indicator as indicated by the VIX.X. So interesting to note. Again, overall sentiment still extremely positive, not too frothy, but we definitely want to keep track of that 50-day moving average. We get above it, we can certainly get another pop, which would indicate, along with some of the internals here, that you're going to get maybe a short-term sell-off and correction, which would be healthy in light of the strength of the overall market. Okay, let's take a look at gold. Well, I refined the trend lines here, or the channel lines, and you can see it's sort of like a widening channel. We connected the lines from here to here, and basically you can see we stopped almost perfectly over the last couple of weeks after the big sell-off. So clearly we are in a bearish phase on the daily charts. 50 is accelerating to the downside. The 200 is also rolling over. A return move back up to this channel line has been handily rejected. So you have a pretty well-defined game plan, which is if we can get above this this channel line here and this level of compression, which is quite a bit, you're certainly going to get a move back up to this declining 50, maybe even a move back up to the 154 level. But even with that, you would still have a lot of overhead resistance. Most likely it would come in really around that 50-day moving average and the channel. But in this market, anything, in these markets, certainly anything is possible. But overall trend is bearish in gold and still down. Let's take a look at something else in the making. This one is a little bit forward thinking. This is OIH ETF, oil service holders. Just want to point out that you have this bottoming formation here. This is on a weekly chart. So this is going all the way back to 2011. Basically, if we can get above the 45 level, you have a potential breakout which would give us a count to almost the mid 50s. So that's a good 10 to 15% rally if we can get above that 45 level. Maybe we can refine it a little bit on a closing basis. If we can get a weekly close, we're still, maybe 44, 50, 45 in that area. You definitely have what I would call this classic head and shoulders bottom formation that has taken years to develop. Now, of course, we could just reject these levels and oil goes and heads back down, and in that particular case, that would be taking out the longer term, the 200-week moving average, as well as the trend line. So this is bounded by the 40 level and the 45 level, but this is certainly looking interesting. The other point I wanted to make is that you had a pretty interesting move in OIH, and you can see this pattern play out on the daily chart as well, and you can see that this daily pattern here, you broke this trend line here, clean break, not even a throwback or a return move to the trend line, which is certainly possible. Return move to the trend line and the 50-day moving average would be another buying opportunity as well. So this is an interesting setup looking at oil or oil service holders. Let's keep an eye on that because this is one of the nicer looking classic bottoming formations, potential bottom formations that I've seen in quite some time. So with that, it wraps up this week. Look forward to seeing you next week. Have a great weekend and see you. And don't forget to sign up for this video newsletter at www.marketgauge.com and be sure to get it free every week. Thanks a lot.